The Federal Reserve surprised markets by delivering a bigger 50 basis points rate cut, but the reaction in the dollar was mixed. So what could the week ahead have in store for the greenback? This is the week ahead. Thanks for joining us at xm.com. I'm Cristina Marujos, and with me today is our lead investment analyst, Rafi Boyajian, to unpack this week. So, Rafi, the dollar might take its cues from the PCE inflation report on Friday. We'll look at that shortly. But before that, the Swiss National Bank is set to deliver another rate cut on Thursday. Now, the franc has been in a bullish mode, to be fair, the last few months. How could we see it move on the rate announcement this week?
Well, Christina, the strong franc has become a real problem for the Swiss National Bank, as well as, of course, for Swiss exporters. And that's one of the reasons, in fact, why the SNB started cutting rates quite early on. Of course, the other reason is that inflation never really reached double-digit numbers as the rest of Europe did in Switzerland. This has helped kind of the SNB to take a looser stance than its ECB counterpart. But of course, although we had seen some weakness in the franc earlier in the year, it's now kind of reaching the highs that it did back in December, and that's why the SNB will probably cut rates again when it meets on Thursday. The question now really is whether they're going to cut by 25 or 50 basis points. I think investors are around about 60% certain that we're going to get a 25 basis point, but still a 40% for a 50 basis point cut. That's still a sizable probability. So either way, I think there could be some volatility for the Swiss franc on Thursday. Now, what's the likelihood that in reality the SNB will cut by 50 basis points? Well, I think they want to send a strong signal to the markets that they're really unhappy about the strong franc, and also they're determined to prevent further appreciation. Then they could go ahead and cut by 50. The problem is that they already cut rates twice this year. At the moment, the policy rate stands at just 1.25%. So they don't really have a lot of room to cut further. So they might not want to deplete their arsenal, their remaining arsenal, and they might instead opt for 25 basis points. But even then, they will probably strike a dovish tone. They will probably threaten that intervention does remain an option should the franc continue to appreciate, especially against the euro, where a bulk of Swiss exports go to, of course, in the euro area. So I think, whether they go by 25 or 50, I think there's probably some downside risk for the franc heading into the meeting.
Now, staying on the central bank front, we have the Reserve Bank of Australia, on the other hand, which is expected to stand pat this week. How might the Aussie perform, though?
So the RBA, of course, had been very hawkish until recently. We are now seeing inflation come down again. So that's allowed the RBA to maybe tone down some of its hawkishness, and we might see further toning down on Tuesday, because inflation on the monthly print is down to 3.5%. That's still above the RBA's target band of 2 to 3%, but I think growing confidence that it is headed within target range will probably allow the RBA to sound somewhat more neutral. The problem is that markets think there's a good chance of a rate cut by December. The RBA has signaled that it's not even thinking about cutting rates, and as we reach closer to the end of the year, I think we're likely to see speculation intensify. So is the RBA gonna signal possible rate cut this year? Probably not, even if there's some dovishness in the language, I think the downside is going to be rather limited for the Aussie, at least until we get a clearer view of where the RBA stands. And it's probably not going to happen until the November meeting, where they're going to have, of course, not just more economic data, but of course they're going to be updating their projections on inflation and on growth. We saw recently the jobs market not doing quite as badly as feared. So the RBA for the moment doesn't have the need to say turn drastically dovish. So I think that even if we do see the RBA heading towards a rate cut, given that markets are already pricing in such a move, the downside will probably be limited.
I see. Now let's turn to the US dollar. It managed to escape a big sell-off from the larger than expected Fed rate cut. How is it likely to react to Friday's PCE inflation report?
So attention quickly turning from the Fed to more inflation data. Of course, the PCE inflation numbers, this is what the Fed puts more weight on when it comes to these policy decisions. Now, the 50 basis point rate cut, it was a bit of a surprise. I think the Fed is worried about, sharper than expected slowdown in the labor market. So they wanted to, I guess it was taking out a bit of an insurance policy against that. And of course, now that inflation is under more control, they can afford to do that. But I think markets are still overly dovish as to how many rate cuts we're going to get from the Fed. So if the inflation data, we don't see downside surprises there, we see only a gradual decline in the US inflation, I think that does pose some upside risk to the dollar because I think the Fed, from what we heard from Powell, we didn't get this signal that the Fed will be cutting by 50 basis points further down the line. They're probably going to go by 25 basis point rate cuts. Markets think that we might get one more 50 basis point rate cut this year. So again, I think unless the data moves in that direction, there's, the dollar, we might see maybe staging a little bit of rebound because, of course, the dollar has already fallen quite a bit in recent weeks. So clearly there's going to be a lot of sensitivity to the incoming data, not just on PCE inflation, but of course the consumption numbers and early in the week with the flash PMIs as well.
Well, speaking of flash PMIs, lastly, we'll be getting this data set from the Eurozone and, of course, the United Kingdom. How might we see the euro and sterling perform?
Indeed. So this is going to be the highlight for both the euro area and the UK. Now, the ECB, although inflation actually is very close to the ECB's 2% target, they're maintaining this cautious approach in terms of cutting rates at every other meeting. And again, from what we heard from policymakers, the next cut is likely to be in December rather than in October. But there are concerns about the growth outlook in the Eurozone, particularly in Germany. So any deterioration in the PMIs would see market expectations being ratcheted up in terms of faster rate cuts by the ECB. However, even in such a scenario, the Fed is likely to be cutting rates more aggressively going onwards. So how much negative would that be for the euro? Probably not much. So I think unless we see a very big deterioration in both the inflation and growth data in the Eurozone, I think the euro will probably be able to maintain its uptrend against the dollar. And it's kind of a similar story with the pound as well. The only difference here is that unlike the ECB, the Bank of England does have more scope to cut rates because both rates in the US and in the UK interest rates are at 5%, whereas in the Eurozone is there at 3.5%. So should the data in the UK start to turn more negative, I think we could potentially see a bigger correction in the pound than in the euro. So that's something to have in mind.
Rafi, thanks so much. This was The Week Ahead here at xam.com.